Welcome back. Welcome back. Thanks for tuning in. If it's your first time on this channel, this segment of my channel is basically about why one should start investing. And if I was starting to invest today, how would a portfolio look like, right? And the main reason that I started this segment on my channel, as you know, my channel, or have you seen, my channel is mainly about like my experiences, where I'm going, where I'm eating, what's the hidden gems. And it's just my experiences that I'm sharing because I want to relive these memories. And it's only because when my mom passed in 2011, I realized that I didn't have much video, right? I had pictures, but I wish I could capture some videos and so I can relive those memories with me. So now I'm going around the world with clients, with family, with my dog, with friends, or within the state or wherever, and making these memories. And I love doing this. I love creating content. I love sharing it with people that I know of. And if you guys are tuning in and watching and like it, please, hats off. I appreciate it. So getting back to the video, the thumbnail is exactly what it says. I want to basically talk about a couple of things in the public portfolio. It's all based on the public portfolio, which I'm really transparent. You can see the videos that I've been posting live on my YouTube channel. If you're 21, if you're 30, and even if you're 14, 50, but if you're 21, if you're in your 20s and your 30s right now, it's a great time to get into the stock market because it's compounding. Your interest, your money is going to make, you're going to just make a good amount of money in the market. Without further ado, let's get straight into it, right? Sleep when you are dead. Make money now in the stock market, right? And understanding what the stock market is. So let's get into it. What I'm talking about today, inflation. What is inflation, right? And if you can hear some grunting or snoring at the back, that's my dog Pedro. He's a French bulldog. He's about 10 years old and he loves to be in whatever room my wife or I'm in. Currently, my wife's on her way back from New York. So he's lying around somewhere in this home office, right? So WTF, my money is in the bank, but it's less, or is it less? But I don't see it decrease, right? And what inflation is basically is that, let me just break it down to you, right? So, but let's state the obvious, right? So the United States is basically about 3.3 or 4%. And what that actually means is if you had about $10,000 in your bank, next month it's going to show you $10,000. Next year it will definitely show you next 10,000 as well. But what that 10,000 can buy, it's a different story, right? So what I'm trying to say is like, basically, if you watch my earlier videos, you would see that I was saying 1920s, 1930s, if you had $100 or $10,000 back then, it bought you a certain amount of things. Just let's use this as maths, right? It bought you 100 things with your $100. In today's market, your $100 is probably buying you 10 things, right? And that's basically what inflation is. It's basically the mindset shift. Instead of thinking my money is safe in the bank, think of this: my money is safe but slowly shrinking in power, and let that sink in. So if you're keeping your money in the bank and it's not in a high yield account, you're not in investing nothing. It's slowly shrinking because of inflation. Simple truth is, we all know that banks are safe. So if it's FDIC insured, we like to open up the app and see that we have 100, 10, 100,000, 1 million, whatever, right? We just like to see that number. It's like what our brain sends a signal, like a dopamine, like, great, I have money, I'm rich. But it's not. The simple truth is that investing is growth. Inflation is the silent cost of doing nothing. So think about it and let's get into it more into detail. The next thing that I want to get into is, what is PEG? Now, when I buy companies and stocks, I look at PEG. What is PEG? So I'm going to connect all the dots, right? We went through what inflation is. We're going to go through what PEG is. So if you didn't know, if I was a bit too fast, just pause the video, go back, watch that part of gain of inflation and do the maths, right? What is PEG? Now, when I buy stocks, I like to do my research and I like to look at PEG. PEG is basically the price to earnings growth, right? So imagine you're picking up a lemonade stand to invest your money in it, right? You and your friend said, okay, let's go, or you and your brother, your spouse, whatever, or you solo, say, I'm investing into a lemonade stand, okay? Basically, what PEG means is, P is price, how expensive that lemonade stand is, earnings, how much money it makes right now, growth, how fast it's growing. Like, how much lemonade are you selling daily, weekly, monthly, yearly, whatever, right? Some dogs bark in the background. Crazy. Anyway, this is life. This is like live, authentic, raw videos, right? So, step two, super simple. Peg is like asking, is this lemonade stand cheap or expensive for how fast it's growing? So, it's basically saying that stand A is basically saying, okay, let's just say your stand A at this point in time, right? So, your lemonade stand makes $10, but it's growing really fast in terms of sales and everything. Like, you're just pushing out more lemonades out, more people are paying you more, you have more custom. Me, my laminate is stand B, right? I'm making $10, but it's just my customers are less for some odd reason. Our items are the same value and everything. So both the lemonade stands from a cost perspective is the same price, right? But your stand A is doing way better than my stand B. So PEG helps you see that quickly, the price earnings growth. The magic number is basically if you buy a company, and you can check online. So if you go and put in like Amazon, what is the PEG ratio? What is this? If you ask in Google, it'll show you. So the fair deal, if it's like around one. If you get it below one, if you see the PEG ratio of this company, this stock is below one, that means it's cheap for its growth and it's a good buy, in my opinion. Again, disclaimer, I am not a certified financial advisor. I'm just sharing what I've been doing in the market and how I've been growing my private portfolio. So going back to PEG in what is actually in real life actually means. So at the end of the day, PEG is basically, am I paying too much for how fast this company is leveling up, right? So what that actually means is that there are some companies where the PEG ratio is like good companies. Like if you look at Nvidia, if you look at again Amazon, if you look at, and some are above too, but you're like, but hey, everyone's buying this stock. The thing is, you want to get the PEG ratio as low as possible for a good stock you think it's a good company to invest in, right? So there's two things you'll see when you check these companies online. PE, that basically shows you the price to earning, if the stock's expensive or not, and the PEG, like I said, price to earnings growth, is basically, is it worth it for growth when you're looking into buy. Now we're going to talk about dividend stocks, right? What are dividend stocks? So let's keep it super simple again. Imagine that you own a tiny piece of a big company like a pizza shop. Now the pizza shop makes money every day. At the end of the month, the owner says, we made extra money, let's share it with everyone who owns a piece, basically the investors. So that money they give you is a dividend. You're an investor, so you're going to get this money just because you own the stock. So besides, if you buy a stock for $100 and the stock price of that $100 stock goes up, if it goes to 150, you made 50. However, there are certain companies out there that also pay you dividends, right? So it's another side of income as well, apart from also owning the stock. You're making money on the stock if it goes up, but you're also making money because they pay you dividends. A real life example is basically, let's say you own a stock like Coca-Cola, you own one share, they decide to pay you $1 dividend of the shares you own. So you get $1 in your account. You didn't sell anything, you still have your stocks, but you just held it, and they pay you. So why do companies actually pay dividends? Because they're like, we are making solid money, let's reward our investors, because you would buy more shares, you're investing. What do they do with the money that you're investing? They usually do it as R&D, and they reinvest it into research development and etc., right? You get the picture. So they're rewarding investors with dividends. Usually the companies who pay you dividends are stable companies, big companies, not fast growing ones. So there's two types of stocks here. Easy mindset, let's get into it. Growth stocks. Growth stocks, like I just explained, don't pay dividends because they reinvest the money that to grow bigger, whether it's R&D, whether it's, I don't know, growing markets, emerging markets, global strategies, right? Dividend stocks are basically paying you regularly, but slow growth, right? But steady cash. Today I'm going to talk about the one I'm highlighting, and I'm adding more to this company, as in I'm accumulating as much as I can because I see this company at a great price. So stay tuned. I'm going to bring that up in the next slide. So owning dividend stocks is like owning a vending machine that sends you money every few months. One thing to know, important, dividends are nice, but don't get tricked, guys. Don't get tricked. A stock paying high dividends isn't always better, right? Because you also want your stock price to go up. So sometimes the company isn't growing much, and then you have to realize, or review the company, the stock that you invested further down the line. Now let's pick my winner up. Now, why I've chosen Nike? Because I grew up in Nikes. I'm a 80s babies, like I said, and I loved the brand. I loved everything about Nike and what it did for the culture back then. When I watched like LL Cool J, on MTV, and everything was surrounded by Nike. It's not that the brand just has a great story and looks good and feels good, but it also like it fits my aesthetics. Like I love the way that how innovative this company is, right? And when I say this, for the last since I moved to New York, the last couple of years I've been following this designer, this creator, this disruptor in the culture. And when I say that I met this individual a couple of times, my wife and I actually met him. I've got gone to a lot of his pop up events, and I'm talking about J Tips. J Tips is from the Bronx. He's collabed with Soconi. He's done some great things. And if you literally see my IG and his stories and everything, and he's on YouTube now as well. Nike signed him, and that's a massive collab. He's always wanted it. So if you look at his journey on online, you'll see that this is a I'm giving him his flowers, and I'm sure he's given his flowers to himself, right? So Nike, in my opinion, is a great dividend stock in the public portfolio. I do own Nike in my private portfolio, but I want to add more Nike because I see it at a price right now that it's great. And I just feel like Nike really innovates themselves. They're this beat down athlete who used to win gold all the time and suddenly is like not winning anymore. But this athlete is coming back bigger, better, in my opinion, right? Again, disclaimer: I'm not a financial advisor. I'm not certified. I'm just sharing what I'm doing and my journey in investing is. Nike shares some of their money with investors, dividends, right? About $1.64 they pay per share. They pay every 3 months, like a small paycheck to you guys, to all investors. That is, their dividend yield is around 3.6% right now. If you own one share, you get about $1.64 a year. But here's the important part, right? Let's get into it. Nike is not mainly a dividend stock. It's more like a cool brand that also gives you a little cash. Easy way to understand this: there are two types again. Big dividend, example, slow, steady companies, right? So Nike, if you look at them, I think they've been in the market they went IPO in 86 or whatever, right? But what I'm trying to get at is for the last 20 or whatever, how many years, if you look up online and Google it, they've been paying the investors, the price is going up, it's increasing, the dividends is going up. But right now, what's happening with Nike? Why is the stock $46.24? If you look at that screenshot that I've put is taken today at 11:45 a.m., right? So the reason why Nike is where they are right now is because they're in this process of coming back. Their business is coming back. Growth matters, so it's important to them, not just paying out dividends, right? So Nike is like exactly like that popular lemonade stand that gives you a few coins every month, but mostly it's trying to grow bigger and sell us more lemonade, right? My honest take, guys, if your goal is cash flow every month, Nike as a stock isn't enough, right, in your portfolio. Mix of growth, some cash, Nike actually fits that nicely. So I'm accumulating more in the public portfolio and in my private portfolio. In my private portfolio, I've got Nike when Nike was at a much higher price. So today, if I look at my private portfolio and see Nike, I'm in a larger position, but I'm in red. Since I started the Robinhood transparency, sharing the public portfolio with you guys, I'm adding more because I see Nike at a really good steal, in my opinion, at this point in time. So I'm adding more on the public portfolio, which is the same thing. If I have shares there and I have shares here, it makes complete sense in my alignment, right? This is one winner that I've chosen as a dividend and a great stock that I'm investing. Again, that's my opinion. So this is a numero uno that I'm adding. If you go back to the early videos, you've seen this in my public portfolio. Nike already exists, but I'm adding more to it. There's another company I also own in the private portfolio, but I'm adding in the public portfolio because it's at a great price now. Cheesecake Factory. You're like, Cheesecake Factory, you invest in this. Yes, I invest in this. Actually, I'm up in the private portfolio, but I want to add more shares to this, and I want to show you guys my journey that I can put this in the portfolio because I want to diversify in the public portfolio as well because it's currently very tech heavy, and my private portfolio is set in such a manner that it's very diverse. So if a recession, COVID happens, I can see things working well in these portfolios, right? So the simple answer is basically yes, Cheesecake Factory pays dividends. Think of it as like this: you own a small piece of a restaurant, people come in, eat pasta, order cheesecake, send money, and at the end of the month, the company says, great, we made them some money, so here's a little slice of your profits, right? So that's the dividend that Cheesecake Factory gives you, right? What does Cheesecake Factory pay? It's about $1.08 per your share. They pay it every 3 months. Dividend yield is usually around 2 to 3%, but it moves with the stock price. So one share is basically $1 a year split into four payments. But here's the real talk. This is not a super safe dividend king, in my opinion, like how Nike is, right? So when I'm looking to add stuff in the public portfolio, I factor all these reasons and everything that why am I adding this to the public portfolio. So why it's not a super safe dividend king is because it's a restaurant business. Restaurants go up and down with the economy and with the reasons restrictions are happening around the world. During tough times like COVID, they stopped dividends completely. That's a big signal. What that means for you is Cheesecake Factory is sometimes pays you, but not always guaranteed. Not like ultra stable coins. Easy comparison is like Coca-Cola as a company. If you invest in Coca-Cola, you know the dividends it pays you consistently and it's been doing this for decades. So Coke is super reliable. Again, do your own research, your own due diligence and see what these companies give you back in terms of dividends, right? So again, Cheesecake Factory pays but can pause when things really get rough because it's in the restaurant industry. It's something to have on radar. How I like to follow things on my radar is basically put it on my stock app, see what is trending, what's the 3 months, 6 months. You got to do this due diligence for yourself because it's your money at the end of the day, right? So basically, Cheesecake Factory is like a restaurant that shares dessert with you, but sometimes they run out of desserts and don't give it anyway. That's the dividend part to it, right? So what am I doing in the public portfolio? Right now in the public portfolio, like I just mentioned, I'm adding more to Nike. I feel it's going to go up. I know, and it's still going through a rough period in terms of stock price, but I know they're going to innovate. They're going to come back a winner. They're going to be again on top. And I don't see anybody else, whether you're Adidas, whether you're Puma, Reebok, On Cloud, or whoever, coming and taking up Nike's position. So that's what I'm trying to say. Like, so I know Nike as a brand, its fundamentals is up there. It's positioned itself really well into the market, and I'm investing in the stock as of now, yesterday, and before, and the future because I see the price going up in the stock, but also their dividends going up, right? So I can make more money by just holding the stock, right? Invest in valuable stuff. I've been a long term, I have that vision of going long term, not for a short term. I don't want to have $100 today and turn into 4,000. That's great. If you guys are trading options, put calls, forex, whatever you guys are doing in your, hats off to you guys. However, I'm an investor. I want to accumulate as much as I can in the right companies, in the right stocks to move ahead, to do better for myself, to take care of my family. You know, I want to build a wealthy portfolio where I have enough of funds that I can teach and I can give back. I think this is like my goal. I want to do more for people out there who don't have the vision, mission, values because of what circumstances they're in. So, with that, I want to leave you guys with this in mind. Don't sleep. Your money isn't growing with inflation. Make sure you invest in good companies. Do your due diligence. Make sure that, you know, if you're shopping on Amazon, also invest in Amazon. If you're using Uber, I would, in my private portfolio, I have Amazon, Uber, Apple, you name it. So surround yourself with the brands that you invest in. Try to do some research and check online. Like, okay, is this a great company? Should I buy it? Blah, or not. And you know, make more of your money. If your money isn't making money, then something is wrong in your ecosystem. In my opinion, when I started doing this since 2015, it's just great that I'm getting free money, right? And it's not free, of course, my money is working for itself, right? But also I'm working for money and then my money is making money. So scared money doesn't make money, feared money doesn't make money. Make your money make money for yourself, right? On that note, peace, make it happen, own it, one love.